All right, today we are diving deep into one of the trickiest and honestly most commonly misunderstood rules in the entire retirement landscape. We're talking about aggregating required minimum distributions, or RMDs, and we're going straight to the source of truth for this, Treasury Regulation 1.401A9-8, to see exactly what the law says.
So let's just frame this with the one question that seems to trip everybody up. Let's say you've got a couple of 401k accounts from previous jobs, the RMD deadline is looming. Can you just, add up the RMDs you owe from each plan and then pull that grand total from just one of them? I mean, it seems efficient, seems logical, right? Well, the answer is a hard no, and knowing exactly why is absolutely critical.
So here's our game plan. First, we're going to tackle the aggregation myth head-on. Then, we'll do a deep dive into the specific regulation that governs all of this. After that, we'll get into the weeds on the rules for separate accounts, pinpoint why IRAs are so different from 401ks, which is the source of all the confusion, and finally, we'll talk about the serious stakes involved if you get this wrong.
Okay, let's kick things off with the big one, the aggregation myth. And I want to be clear, this isn't some minor technicality. It is a very common mistake that can lead to some really significant and costly penalties for everyone involved. This right here is the heart of the problem. Most of us are familiar with the flexibility we have with our IRAs. You can add up all your IRA RMDs and take that total amount from whichever IRA you want. It's easy. So it's totally natural to assume you can do the same thing with your 401ks, but the reality couldn't be more different. For qualified plans, this is absolutely explicitly forbidden.
So where does this really strict rule actually come from? Well, this isn't just some vague industry best practice. It's written in black and white directly into the Treasury regulations.
And here it is. This is the exact language from Treasury Regulations Section 1.401A9-8, Answer 1. The wording here is completely unambiguous, not permitted to be aggregated. It doesn't leave any room for interpretation. Each plan has to stand on its own 2 feet and meet these requirements all by itself. This is the legal bedrock for the entire rule.
So this leads us to the crucial concept, the aggregation prohibition. And honestly, the best way to think about this is that each of your qualified plans, your old 401k, your current one, a profit-sharing plan, is its own island of compliance. It's a completely self-contained world. You have to calculate the RMD for that island, and you absolutely have to take the RMD from that specific island. You simply cannot build a bridge to another plan for RMD purposes.
Now you might be wondering, why? Why is the IRS so incredibly strict about this? Well, it all boils down to legal structure and just plain administrative reality. See, each 401k is a totally separate legal trust. Your current boss, the plan sponsor, has absolutely zero visibility or control over the money in your old 401k with a previous employer. If you could aggregate, it would create an impossible paper trail for the IRS to audit. This rule keeps it clean. Each plan sponsor is responsible only for their plan, which means compliance can be checked one plan at a time.
Okay, so while you can't aggregate RMDs between different plans, the regulations do have very specific rules for how benefits are divided up within a single plan. This gets really important in situations like post-death distributions or divorce.
This is where the rules get a little more nuanced. Let's say a participant passes away and leaves their 401k to, say, 3 different children. The plan is allowed to establish separate accounts for each of them, and the benefit here is huge. It means each beneficiary can calculate their RMDs based on their own age and life expectancy. But, and this is a really big but, there is a critical, non-negotiable deadline. Those accounts have to be officially established by December 31st of the year after the participant's death.
And what happens if you miss that deadline? Well, the consequence is severe. If those separate accounts aren't properly established on time, the default rule kicks in. The RMD for every single beneficiary, even if one is a 25-year-old grandchild, has to be calculated using the much shorter life expectancy of the oldest beneficiary. That can dramatically accelerate the distributions and the tax bills for everyone.
The regulation also gets super specific about the accounting here. So in that period between the participant's death and when the separate accounts are formally set up, all the investment activity, gains, losses, you name it, has to be allocated on a pro rata basis. Once they're established, then each account's activity stays within that account. And notice that last point, the aggregation prohibition applies even here. Beneficiary A cannot take their RMD from beneficiary B's account, even if it's all within the same plan.
This same logic also applies to Qualified Domestic Relations Orders, or QDROs. A QDRO is a court order. usually part of a divorce, that splits a retirement account. Well, that QDRO automatically creates a separate account for the former spouse. And you guessed it, that account becomes its own island of compliance. Under the regulation, it has its own separate RMD obligation that cannot be mixed with the participant's remaining balance. The rules also give the plan a nice little safe harbor for up to 18 months while that court order is being processed and qualified.
Okay, so this brings us right to the #1 source of all this confusion, the completely different set of rules for IRAs compared to qualified plans like 401ks.
This table just lays out the massive divide perfectly. Look at that top row for traditional IRAs. Yes, you have to calculate the RMD for each account. But can you aggregate the withdrawal? Yes, absolutely. Now, drop your eyes down to the 401k line. You still calculate for each one, but can you aggregate? A big, fat no. Each plan stands alone. This visual really drives home why that common assumption we talked about is just so wrong.
And just to add one more layer of nuance, we have 403b plans, the ones you often see with schools or nonprofits. They get their own special rule. You can aggregate RMDs between your 403b accounts, but, and this is key, you can only aggregate them with other 403bs. You can't use a 403b withdrawal to satisfy a 401k RMD or an IRA RMD. They're their own little aggregation club.
So this all leads us to the final and most critical question of all. What actually happens if you mess this up? What are the compliance stakes? And as you can probably imagine, they are very, very significant.
You see, an RMD failure isn't just one problem. It actually creates 3 distinct tiers of risk. First, at the highest level, it's considered an operational failure that can technically jeopardize the tax-qualified status of the entire plan. Second, there's a direct and very painful penalty that gets levied on the participant. And third, it opens up the plan sponsor to potential fiduciary liability for letting the mistake happen.
So, that penalty for the participant, it is absolutely staggering. Under the Internal Revenue Code, the excise tax for failing to take a timely RMD is 50%. That's 50% of the amount that should have been withdrawn. It is easily one of the most punitive taxes in the entire U.S. tax code. And this is where that risk can boomerang right back to the employer. Imagine a participant gets slammed with that massive 50% tax. It's not a stretch for them to turn around and argue that their employer, the plan administrator, breached their fiduciary duty by causing or allowing that RMD failure to happen. And just like that, the financial fallout shifts from the individual directly onto the plan sponsor.
So, after all of that, the crucial point to take away is simple. Let's go back to our metaphor. Each qualified plan is its own island of compliance. The rule against aggregation isn't just some administrative headache or a piece of red tape. It's a fundamental requirement that's baked into the core legal and fiduciary structure of our entire retirement plan system.
And all of this leaves us with a final, bigger question to think about. In today's world where people change jobs more than ever and accumulate multiple accounts, is this rigid plan-by-plan complexity a necessary feature to ensure compliance, or is it maybe an outdated flaw in a retirement system that's trying to modernize? It's definitely something to chew on. Thanks for joining this deep dive with us.